The RBA is widely expected to lift interest rates today for the first time in 11 and a half years, and most economists expect that rate rise this afternoon to be replicated each and every month now until Christmas. Joining me live is Chief Economist at AMP, Shane Oliver. Shane, we had heard that economists, up until we saw that inflation data, was going to hold off to June. So what's changed?
Basically, it was the inflation data. We've seen a progression here earlier this year. I guess you may recall the Reserve Bank was saying the first rate hike wouldn't come till 2024 at the earliest, or maybe 2023. Then, of course, this year became plausible. And a month ago, they said that they'd be watching inflation and wages data. We haven't yet got the wages data, but the inflation numbers blew the lights out, far stronger than expected. And of course, that's why most economists have brought forward the timing of the rate hike from June to May. There's still a few saying, yeah, it could be in June. And that's quite possible. They decide to delay till after the election. But I guess the problem is those inflation numbers were just so high that to delay obviously risks further adding to inflation pressures. So I think it most likely they will hike. But of course, the Reserve Bank sometimes does have a habit of surprising us.
Shane, we are in uncharted territory here. We haven't seen rates this low really ever. So how many rate rises will it take to see inflation go down?
Well, that's a big unknown. On the one hand, you're right. We are at record low interest rates. Normally, zero is the official cash rate is zero. In the 1970s and 1980s, we ultimately had to get the equivalent of the official interest rate up to around 18% or thereabouts before we ultimately got inflation under control. And of course, that brought on a recession. Now, the world today is very different. The starting point on inflation is a lot lower than it was back then. So hopefully we won't have to go anywhere near that. The other factor, of course, is that household debt is many, many multiples of what it was back then. Even if you allow for higher household incomes, the ratio of household debt to incomes is multiples higher than it was back in the 1980s and 90s. So my feeling is that 2.5% or 2% to 2.5% would probably see the top in short-term interest rates, but we probably won't get there until maybe another 18 months. But bottom line is we still have we have a fair way to go to get to that point. And of course, the Reserve Bank won't be on autopilot here. It will be seeing the impact along the way, seeing how households are coping. Obviously, it doesn't want to crash the economy, or let alone crash the property market. Just wants to cool things down. But bottom line is we do have a fair way to go in terms of getting rates back to a more normal level that might be consistent with controlling inflation.
Shane, in your view, has the RBA moved too slowly?
With the benefit of hindsight, I think you can say that, and you can say that about many central banks around the world. They initially thought, as did many economists, including myself, that the pickup in inflation we're seeing was transitory. Here we are a year later and it's still going, and there's still inflationary threats out there. Obviously, the lockdowns in China at present that are COVID-related add to those pressures. So the problem for central banks is that by continuing to wait and find excuses to delay, that inflation gets higher and higher, and that locks in higher inflationary expectations. People expect inflation to stay higher, and then it gets a lot harder to get it back down. So bottom line is, they have taken a little bit too long to start moving, and I think the same applies to the Reserve Bank. But of course, that's only apparent in hindsight, and a year or two ago, the big concern was that inflation had been too low. So you can't criticise them too heavily.
No, okay, yep. Hindsight's always a wonderful thing. We're in a glass house here, so I'm not throwing stones at all. Shane, before I let you go, you mentioned household debt and that being relatively high. The politicians want to concentrate on the fact that there is a lot of household saving as well through COVID. Some people have done better. How are those two balanced, do you think?
Well, they've balanced out quite well, but there is still a problem. Household debt is still higher. And there's, I guess, what you might call distributional issues. There's a group of households there who have a mortgage, have had their mortgage for several years. They've taken advantage of the very low interest rates to get their debt down, partly because they couldn't spend over the last couple of years when they were in lockdowns. Some of them may have got assistance from government, and they've used that to pay down their debt or be well ahead on their payments or be making payments that are way higher than they need to be. So roughly speaking, some RBA analysis showed that there's 40% in households who would see no increase in their monthly payments if interest rates were to rise 2% from here. But there's another group, about 25 to 30% of households, who would actually see quite a substantial increase in their payments. And that group, they're likely to be the people who got in more recently, haven't had much time to get their debt levels back down, struggling more in terms of they're making their income meet their costs on a weekly, monthly basis. So bottom line is, yes, there's a big chunk of households who won't feel a lot of pain out of this. They're already running ahead. They use that savings buffer to protect them, but there's also a significant group who obviously are more at risk. And it's that group that the Reserve Bank has to keep a close eye on, which is why I think they'll probably do a few hikes up front. Maybe do one of these hikes might be 40 basis points or 50 basis points, and then they'll have a bit of a pause just to see how the household sector is handling it. Because, as I mentioned, they don't want to crash the economy, let alone the property market. They just want to cool things down. So that means that at times they're going to want to have a bit of a pause and see what the impact's been.
Shane, thanks so much. Great to get your expertise this morning. We'll be watching this afternoon as that decision is handed down.